You know, in finance, there's a number that's basically a company's panic button. It's the ultimate stress test, designed for the absolute worst-case scenario. It's called the cash ratio, and it answers one of the toughest questions a business can ever face. If everything went completely sideways, right now, could you actually survive?
So, here's what we're going to cover. We'll start with that ultimate stress test. Then we'll get into the anatomy of the ratio itself, the formula. After that, we'll decode the results, see what they really mean, and look at how different stakeholders use this number. We'll also zoom out to see the bigger liquidity picture, and finally, tackle the really interesting paradox of having way too much cash.
All right, so to really understand the cash ratio, we've got to go to a pretty dark place. Let's just imagine the single worst day in a company's entire existence, a day where literally everything that could possibly go wrong does. Just picture it for a second. Sales just stop. Zero. No new customers walk in the door. All your existing customers just stop paying their bills. The warehouse is packed with stuff, but no one is buying a single thing. The entire engine of the business just grinds to a halt. That is the exact scenario the cash ratio is built to measure. You can really think of it as the doomsday prepper's toolkit for finance. Seriously, it's not for checking on the day-to-day health of a business. No, this is for measuring a company's ability to survive a Category 5 hurricane. It asks that one brutal question: if your business operations failed completely, right this second, could you pay your immediate bills with only the cash you have in the bank?
Okay, so let's get into how we actually calculate this thing. The formula itself is incredibly simple, but its real power comes from what it includes, and maybe even more importantly, what it deliberately leaves out.
And here it is. It's that simple. On top, you've got cash and what are called cash equivalents. That's the most liquid, ready-to-spend stuff a company owns. And on the bottom, you have current liabilities, basically all the bills that are due within the next year. It's a straight-up, brutal comparison, the money you have versus the money you owe right now.
Now, this right here is what makes the ratio so incredibly honest. It completely ignores things like unpaid invoices from customers, that's accounts receivable, and all the unsold products sitting in the warehouse, that's inventory. And why? Well, because in a real crisis, you have absolutely no guarantee you can actually collect that money or sell that inventory. The cash ratio just assumes they're suddenly worth nothing.
And what's on the other side of the equation? The denominator? Oh, these are all the obligations that are breathing down the company's neck. We're talking money owed to suppliers, short-term loans from the bank, employees' salaries, taxes, all the bills that do not stop coming, even if your sales have.
So you do the math, and you get a number. But what does that number actually tell you? See, interpreting the cash ratio isn't as simple as high is good and low is bad. It's really about trying to understand a company's strategy.
Typically, analysts think about it in three zones. If your ratio is below 0.5, that means you have less than 50 cents in ready cash for every dollar you owe right now. That's a pretty risky spot to be in. A ratio between 0.5 and 1.0 is usually seen as the sweet spot, right? A healthy balance between being safe and being efficient. But, and this is interesting, if you're above 1.0, while it sounds super safe, it can actually be a red flag that you're not using your money very well.
So, at the end of the day, what's the goal here? Well, it's this constant balancing act. A company's management is always trying to find what you could call a strategic equilibrium. They need enough cash on hand to keep the lenders happy and to survive a sudden shock, but not so much that it's just sitting there doing nothing and not earning a return for the shareholders.
And that balancing act is exactly why so many different people look at this one ratio, but they're all asking very different questions. Let's take a look at who's using this number and what they're trying to figure out.
Think about it. If you're a creditor, like a bank, you love a high cash ratio. For you, it's all about one thing: risk. Can this company pay us back no matter what? But if you're an investor, you're looking at it a bit differently. You're wondering if the company is strong enough to get through a recession. And if you're management, well, you're stuck in the middle, trying to keep everyone happy, staying safe enough to operate, but without wasting capital that could be used for growth.
Okay, but here's a super important point. As powerful as the cash ratio is for this kind of stress test, you should never, ever look at it in a vacuum. It's actually part of a whole family of liquidity ratios, and when you look at them together, you get a much, much richer story.
You can kind of think of these ratios as a ladder of toughness. Down at the bottom, you have the current ratio. It's the most lenient. It counts everything, including inventory. Then you take a step up to the quick ratio, which gets a little stricter by kicking out inventory. And then, at the very top, you have the cash ratio, the toughest, most conservative of them all. It only accepts pure cash and cash equivalents.
And this is where the real analysis comes in. You have to look at the gaps between these numbers. If there's a huge difference between a company's quick ratio and its cash ratio, what does that tell you? It tells you that the company is really dependent on collecting those customer invoices just to stay afloat. It helps you diagnose the quality of a company's assets.
Speaking of real-world analysis, let's look at this number right here, 0.43. This was Apple's cash ratio in 2024. Now, wait a minute. According to that chart we just looked at, that number falls squarely into the high immediate risk category. So, is one of the most profitable companies on planet Earth actually about to go under?
Well, obviously not. And this is where context is absolutely everything. A company like Apple has unbelievable borrowing power, and it generates mountains of predictable cash flow every single day. They make a strategic choice to operate with a low cash ratio because they can. They'd rather put that money to work growing the business and returning it to shareholders. They don't need a huge emergency fund because for them, access to cash is practically unlimited.
And that brings us to our last, and honestly probably the most interesting point, the paradox that having too much cash, being too safe, can actually be a bad thing.
It's a really fascinating question, isn't it? Can you be too safe? Well, if you ask a shareholder, the answer is a resounding yes, because every dollar of cash that's just sitting on the balance sheet isn't working. It's lazy money.
The whole thing boils down to a core economic idea you've probably heard of: opportunity cost. Every single dollar a company keeps in a low-yield savings account is a dollar that isn't being invested in a new factory, or research for a new product, or just given back to shareholders who could invest it themselves.
And the downsides of hoarding cash are very real. First, that cash loses its value over time thanks to inflation. It also drags down key metrics like return on capital. And it can create this weird debt paradox, where a company might be paying, say, 6% interest on its debt, while that big pile of cash it's holding is only earning 1%. That's just not good management. This quote right here just nails the challenge for any analyst. When you see a company with a really high cash ratio, you have to dig deeper. Is management being smart and cautious because they see trouble on the horizon? Or are they just out of good ideas, letting shareholder money get stale because they don't know what else to do with it?
And that really leaves us with the ultimate question you should be asking anytime you look at a company's cash position. Is that pile of cash a strategic weapon, ready to be used for acquisitions and innovation? Or is it just a heavy shield, signaling a management team that's operating out of fear instead of opportunity? The answer to that question will tell you almost everything you need to know.